So it's funny. The funny thing is, even before I get to that, because I just have to say this, you know, we talked about LinkedIn and using the social media and the platform, building the brand, educating people about it. The funny thing is, I talk about cost segregation very, very little, actually on the platform. So, you know, I'm going on podcasts like this, and that's really where the main platform I'm using. And LinkedIn is more of a branding thing. So people associate my name with cost segregation, but probably about 10% or so of the content that I put out is related to cost segregation, which just goes to show you that even though I'm not putting the content out there, people still figure I am, because they just see that name with that. So they relate that. So that's just a kind of a parenthetical note on how I'm using that. But what is cost segregation? Because even though people will say, oh yeah, he's the cost seg guy, but no one really knows what it is. How does it work? And I'm sure a lot of people do, but very few. So let's break it down. It's a really weird name. Okay. Let's just get over it. It's a weird name. Segregation, like who's talking about that in the 21st century? But it's talking about depreciation. Okay. And let's just make it really simple. Take a step back. Depreciation is a tax deduction, income tax deduction the IRS gives you based on the fact that you bought a property. And it starts the day that you buy a property. So in a way, it's kind of like a hypothetical tax deduction based on the principle that things go down in value, right? That's the word, depreciation. So it's going down in value. But when you buy a piece of real estate, commercial real estate, it's usually not going down in value. It's usually actually going up in value. It's appreciating. So what is depreciation? Where does this come in? The IRS gives you this tax deduction based on the principle that things go down in value. And it's totally dependent on the amount of money that was spent to buy the property. So even if you bought it fully discounted, let's say you bought a property that's worth $20 million and you bought it for 10, you get to write off $10 million as a tax deduction, okay? Now that is spread out over a long period of time. It's, IRS says for residential properties, including multifamily, it's over a 27.5-year period. You get to depreciate, meaning take a tax deduction of that value over 27.5 years. For all other commercial types of property, it's over a 39-year schedule. So you take a $10 million building and you take a little bit every single year of tax write-off from your income tax, meaning you're lowering your tax liability by taking that deduction. That's what depreciation is. Okay, cost segregation is just an advanced form of that. It's saying you have stuff in your building, in your property that actually, according to the tax code, depreciates or has a faster useful life. So it depreciates on a faster rate, either at a 5-year, 7-year, 15-year rate. There's a bunch of different categories, but those are the main ones. So instead of lumping everything together and taking, a $10 million write-off every year for 27 years, $300,000 a year, I get to front load a portion of that and really take those assets that depreciate at a faster rate at over a 5-year period or et cetera. So it's like component depreciation is another name for it. So it's depreciating the property according to its different components.
Awesome. I think you broke that down very well. I'm sure you've had, tons and tons of conversations to refine that as well. Can we also explain what are some of the things that you're talking about and how significantly does it actually affect the depreciation? So let's just say, let's stick with the high level numbers you were throwing out there, $10 million building, $300 a year. If the math isn't perfect, everybody get over it.
Exactly.
How much does it actually change? And what are the components that actually allow you to do that?
Right. So part of the process of cost segregation is having an engineer come to the building, identify what those assets are that depreciate at a faster life. So I mentioned a couple of categories, 5-year, 15-year, just break that down and get into how that works. 5-year includes anything that's considered personal property. So anything that's not part of the structure of the building. And that can include furniture, fixtures, appliances, equipment of any kind, carpeting, wall coverings, window treatments, special purpose lighting. So you have lighting, you have LED lighting, that kind of stuff. And a lot of other stuff, cabinets, countertops, all that kind of stuff. Anything that's not part of the structure, all that value, an engineer comes and identifies how much of that you have 20,000 square feet of carpeting. Okay, so now what's the value of that carpeting? Now I can take that value, allocate the entire purchase price, right, to a certain percentage, a certain value is in the carpeting. A certain value is in the furniture. Now I can take that value, write that off as a tax write-off over a 5-year period. 15-year category is the second main category. That's land improvements, which is a lot of times overlooked. Firstly, land itself does not depreciate. So when you buy a building, a certain amount is always allocated to land, which means you're left over with the building and everything that's in it, but land doesn't depreciate. Subtract that from your purchase price, and that's the amount you're depreciating. But land improvements, like what is that? That's like landscaping, pavement, fencing, anything outside of the building. All of that actually has value to it, and a lot of times a tremendous amount of value. And that value can be taken as a tax write-off over a 15-year period of depreciation. So how does this translate? Okay, let's say you have a multifamily property. I know you guys are in multifamily, so we'll just use that as an example. It's pretty common, and I don't know, what you guys have seen, but it's pretty common for a multifamily building. Garden style obviously is different than a city type property, but garden style multifamily, maybe single story, double story, something like that. You'll have somewhere between 15 to 25% of the basis, the amount of the property value, into that first 5-year category. Okay. Then another 5 to 10%, maybe more, into the 15-year category. It can change. It varies property to property because each property is unique, has different square footage, has different,
of course,
assets in them, et cetera. But just generalizing. So let's take an average. Let's take 20%, okay, of your 5-year property. Let's take your $10 million building. Let's just put it into numbers. How does it affect you? How does it affect your ROI? How does it affect your investors? Simple math, $10 million building. Okay, subtract a little bit for land. You're left over with a basis, let's say $8.5 million basis, divide it by 27.5, 300,000. Okay, simple math. 300,000 a year is what your tax deduction is going to be every single year. Regular straight line depreciation.
Yep.
Now, on a $10 million building, what's your NOI? Or how much money are you making? What's the income on a property like that? Average.
Let's see. $1 million.
After you guys have.
$1 million would be a 10 cap. 500 would be a 5 cap. So somewhere in there.
Well, no, that's NOI. The gross that's gross. So to take like Parker Blending, perfect example, right? The NOI was like $650,000.
Yeah.
Yeah.
That's what I was saying.
Okay.
Between 500 and $1 million, a 5 cap and a 10 cap. Yeah.
Okay. So yeah, great. So 650 is a perfect example. So your regular straight line depreciation deduction would have been about 300, just rounding up, which means you made, after all expenses, after everything, you made $650,000 in your pocket. And right off the top, you take 300 off for depreciation, which means you're only left over being taxed on the remaining 350,000. Okay, that's regular depreciation. Comes in cost segregation and says, hey, let's take 20% of that. Okay, put it in the first 5 years as front-loaded depreciation deductions. Let's say, so that's about 1.7 million on the $10 million property, right? 8.5, 1.7 million of extra depreciation in those first 5 years. So you already have about 300,000 every year, right? Split up you're basically taking an extra about $350,000 a year over the next 5 years, which means you're doubling your depreciation deduction. So that's $650,000, which only 350 was going to be taxed on. What happens if you take an extra 350? So basically your tax liability is zero.
Yes.
Which means in those first 5 years, you're essentially making $650,000, paying zero income tax on all of that, as opposed to paying taking regular depreciation, $350,000 being taxed on. Hey, listen, if you're being taxed at a 30% rate, 39% rate, something like that, you're basically paying a couple $100,000, $150,000, $200,000 to the IRS. Okay. So how are you getting around? You're basically spending a few $1,000s on a cost segregation study and saving hundreds of thousands of dollars in taxes. So that's in a very, brief nutshell of how it works. Now, obviously there's a lot that goes into it. There's an entire report that has to be prepared. There's a whole, that has to back up those numbers. You can't just throw a dart at the wall and say, okay, 20%, and let's just take it right off and do it like that.
No, for sure. I think it's important that if anybody's listening, this is not something you can just do on your own. This is not something your accountant's just going to do. Like you said, you have to have certain engineers. You have to do physical inspections of the properties. all those things you mentioned have to be cataloged and accounted for. Right. This is not a simple process. It is fairly, time intensive a little bit. It definitely takes some energy and some personnel and some money to do. So, make sure you go to the proper people to do it, and get it done for you. Question though, go ahead, John.
No, I was going to say, because the part that you just mentioned, I think, and you could speak to it more, that's the reason why it's so beneficial, right? Because whether you go to the proper people or not, and you do it, let's say you just do it, right? The IRS is going to say, whoa, you can't do that. But one of the major benefits to a cost seg is that the IRS says, oh, third party, it was done. I don't want to say anything's, audit proof, but correct me if I'm wrong. Once you pay that third party to go through it with a fine tooth comb, it basically takes the level of risk off the table to you as the investor or the owner of that property. Is that correct?
Exactly. Now, all of the rules for cost segregation are laid out and delineated in the tax code. So all this comes from the IRS. It's not some like tax loophole, some sort of like. So you're exactly right, John. When you're following the rules, and part of those rules in the cost segregation audit techniques guide is that it needs to be prepared by someone with a background in engineering. You need to follow a whole numbering system. You have this whole nomenclature. This whole report has to be backed up with pictures and with documentation and all that kind of stuff. So yes, using a third-party firm, using someone who is skilled in that, the expertise, the experience is obviously going to take the audit risk totally out the window. Because if you just have numbers, and if a person were ever to get audited, which don't wish on anyone, but when that happens, they're going to look at your depreciation and say, whoa, like this is a lot. You have a cost segregation study? Yes? Okay, let's see it. It's good? Great. If not, no, sorry. You can't just make up these numbers on your own.
Correct. And that's the other thing. I think another myth, and whether our listeners know this or not, a lot of people know, or it's always been historically, like you said, accountants knew about it. A lot of people think cost segregation, they really think only new construction, because in that schedule, you'll see, 15,000 screws and 18,000 pieces of lumber. So people, I know when I first started, they always associated a cost segregation with like a $20+ million Class A development.
Right.
But that's not the only reason where it's done. Yes, it benefits that as well. But a lot of myth out there is that you can't use it, or it doesn't make sense to use it for an existing 1960s built deal, and or even to the next point, even a single family house, people do it too. So can you touch on that or debunk that a little bit for people?
Yeah, I think part of the history in that is that, cost segregation has been around for a few decades, been 40 plus years. But until about 10, 15 years ago, and this is really where our company was founded about 15 years ago, is that it was only relegated to large, huge corporations that could afford the big four, accounting firms that were doing cost segregation in-house. And the CEO of our company came from KPMG, and Grant Thornton is the head of the cost segregation division. And these big accounting firms had a corner on the market, and they were charging an arm and a leg. We're talking $50,000 or more to complete a cost. So it only made sense on large commercial buildings. You're talking $10, $20 million purchases or developments. That being said, there was a big shift in the market when a lot of these companies like ours started popping up and were offering the same services, all in-house. And so it started becoming more popular.